is the Bitcoin bounce in, tracking the government shutdown, and looking across a ton of charts in global macro. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today I have a massive update for you. I have a couple dozen charts across Bitcoin and global macro. We'll look at rates, definitely peek at the repo markets and track what is going on with the funding tightness that we saw during October, and lots more. Before we get into the Bitcoin price, a quick look at United States total credit card debt. This is the amount of debt issued to the retail part of the U.S. economy, those that are borrowing and spending on their credit cards. This is a 10-year chart. You could see a dip during the pandemic, and since then, a steady march higher in credit card debt. What does this tell us? What's the signal for the U.S. economy? Well, the retail side of things, they're still borrowing. Does it mean we're at the late stage and a lot of defaults are coming? Well, we'll look at defaults later. But right now, credit extension is there. It's supporting spending in the U.S. economy. So we don't want to think about recession as just a function of credit card debt and defaults. However, we want to think about extension to retail as being a supporter of aggregate spending in the economy. So just from this chart, I'm not seeing a slowdown on the horizon in retail spending. We're going to talk about the labor market too. There's weakness underlying the labor in the labor market. So lots of things to factor in. And today's episode, definitely we're going to take a tour around different narratives in the US and global economy. Let's start with relative returns. We're looking at 12-month trailing returns here across Bitcoin, gold, the S&P 500, and US Treasuries. The performance on Treasuries, you can see up 3% trailing 12 months. Not a bad performance from the 10-year sector. US Treasuries have stabilized this year. That will be another theme we'll continue to talk about, especially when I show you 30-year yields and tell you what the Treasury announced this week for their issuance schedule. Actually, quite big news out of the Treasury. 13% S&P 500 trailing 12 months. The S&P putting in a good 2025. Definitely had some trouble earlier in the year, but the S&P up 13%. Bitcoin now underperforming gold trailing 12 months. Bitcoin up 34% and gold now up 50% trailing 12 months. So an interesting outperformance of gold versus Bitcoin. One of the things that I have definitely started to chart more is the Bitcoin price relative to gold. Another mention of something I noticed this week on the charts, a lower low in Bitcoin's price, but a higher low in Bitcoin's price versus gold. And that is a bit of a bullish divergence, an unorthodox bullish divergence, but one that I definitely noticed. And I will continue to watch that 98, 99 level to see if it holds. If it does, it's telling me that Bitcoin is trying to reverse this current mini bear trend. This is Bitcoin's price trailing 5 years. The red line is the 200-day moving average, and the blue line is the short-term holder realized price. These are both metrics that we watch to see how Bitcoin is behaving around them. They're never explicit support or resistance. However, in our framework, we're looking at what happens when the price gets below the short-term holder realized price. There's a pressure on top of the price. On the 200-day moving average, it's really just a trader mechanism to look at past price and look at how Bitcoin is performing. Is Bitcoin's 200-day moving average rolling over and the slope turning negative? Not yet. That's not something we're seeing. If it is, that will be something to watch, because then you're really seeing Bitcoin lose momentum over a more medium-term horizon. But yes, Bitcoin struggling right now in the short term and trading below both of these levels. Let's look at Bitcoin's MVRV. This is the market price relative to the realized price. Bitcoin's realized price at $56,000 today. a very steady and impressive climb over the last 2 years in Bitcoin's realized price. There you can see after 2 years prior, meaning 2022 and 2023, an unchanged realized price. That means coins and the cost basis of coins really not changing much as that market went through a big bear and a frozen period. In the bull market 2024 and 2025, Bitcoin's realized price, very, very impressive climb. The ratio of its price to realized price is now at 1.81. Let's point out a couple things about this MVRV at 1.81. First of all, it is nowhere close to the 1 or less than 1 level. This would mean that the whole Bitcoin network is trading at a loss, and usually the sign of a deep bear market, and usually what it does is it tells us that this is a good accumulation zone for Bitcoin. So we're nowhere near that type of bear market. We also, it's very interesting to me that a 1.81 reading on this MVRV is not low. In fact, it's right around where Bitcoin trades in these bull markets. We saw Bitcoin's MVRV chopping between 2 and 3 for the last couple years. So it's trading a little bit under that 2 level, but nowhere close to the 1 level. That tells me that Bitcoin is still in a bull market, and the fact that Bitcoin hasn't even come close to the 3 level on MVRV at all this year tells me that Bitcoin is in no way overheated. There's no excess speculative energy underlying the Bitcoin market. Now, I want to mention also that the Treasury companies that are starting to liquidate their Bitcoin holdings, this is more typical behavior of over-leveraged players getting washed out. That happens in bull markets just as well as in bear markets. But I think it's healthy to see selling from companies that over-accumulated. But the most important thing I believe here about the market price to realized price is that the realized price is marching higher. The price at 100,000 is being responded to by participants in the market that are moving coins on chain. These are the ETFs, retail, and these treasury companies. So when they buy, they're moving coins. When they sell, they're moving coins. That strikes a higher cost basis, drags up that realized price. I believe something that's very supportive to the market. Now, could Bitcoin go back down and tag its realized price? That's always a risk. So that's why we watch technicals. The mid 90s is a key area for Bitcoin to hold if it wants to hold its trend line that's been intact since October of 2023. Bitcoin and S&P rolling correlations, you can see in that middle pane, the red reading at 0.6, Bitcoin and stocks highly correlated right now as there's some uncertainty in the markets, perhaps due to the government shutdown, perhaps due to some weakness underlying in the economy. That's what we are watching, and a weak stock market definitely has put some pressure on Bitcoin this week. Or we could even say vice versa, that a very weak Bitcoin market last week put some pressure, downward pressure on the stock market. The two trade as liquidity assets. We're going to show you TBL liquidity here shortly and how we think about what are the drivers behind the stock market and Bitcoin. Right now, high correlations between stocks and Bitcoin. It means that there's just a general uncertainty in the market causing these two to trade in tandem. What are the correlations between Bitcoin and non-S&P 500 asset classes, such as gold or such as the dollar? You can see in the fourth bar there, and then over to the seventh bar, gold and the US dollar. Bitcoin and gold don't really have much correlation. That's why you see it close to zero and actually straddling both sides of that zero line. And this is looking back 1 year, Bitcoin versus these other assets, the correlation. You can see on the left, small caps in the S&P 500, high correlations. And the entire time, meaning looking back 1 year, the entire time it's been positive to very positive. There's no time where these assets are negatively correlated. When I talk about Bitcoin not being a safe haven asset, I'm not dismissing those that treat it as one. Many of you out there are doing so, and I've even said that I'm treating it in a similar way. But that the market tells us that it's a risk asset. That's what these bars on the left tell us. You look at the dollar, the seventh bar there, below zero for the entire year. What it means is that Bitcoin is negatively correlated with the dollar. When the dollar goes down, Bitcoin goes up and vice versa. Well, what's happened in the dollar this week? A little bit of a reversal. Dollar decline, that has supported Bitcoin. Finally, Bitcoin getting a lift from the dollar going down. TBL liquidity. This is our metric on how we judge the conditions for these risk markets, S&P 500 and Bitcoin. And you saw those high correlations. It means that when we do studies on liquidity, we have to look at both the S&P and Bitcoin and what our index does to each of these two asset classes. If we were only looking at Bitcoin, then we're missing part of the driver of Bitcoin's price, which is how it responds to the larger risk market. Before we look at a liquidity chart of TBL liquidity, I want to show you other asset classes and the size of those asset classes versus Bitcoin so that you can see when we do our quantitative research and development, we cannot look at Bitcoin in isolation. We have to look at stocks. In this slide, we're looking at the size of US capital markets. $67 trillion is the size of the NASDAQ and the New York Stock Exchange aggregate companies, their market cap. $67 trillion. Well, where's Bitcoin on this chart? It's not on here because it would be so small you could barely see it at $2 trillion. So stocks, US stocks specifically, at about 30 times the size of the Bitcoin market. This is a massive difference in size of these two markets. And so we do have to think about stocks. What is driving stocks? And that really helps us hone in on what is the driver of Bitcoin. A quick peek at the Treasury market, now above 38 trillion in total debt. It is steadying versus GDP. That's something we love to see. The United States Treasury market, much maligned in terms of the aggregate debt, but that 38 trillion needs to be compared to the GDP of the country, the tax receipts of the country, and the asset base of the country. What is the wealth? That 67 trillion in equity market cap, how much of that do you think is sitting in net equity positions on American household balance sheets? It's a ton, tens of trillions of dollars. So you can't just look at 38 trillion in US government debt and sing sad songs about it. It must be put in context. Now, I strongly believe that the US GDP is heading to 40 and 50 trillion over the coming years. So as long as the Treasury debt is increasing at a pace that is lower than GDP growth, that is what the recipe is for a strong financial position for the United States. I do believe that the US has made a shift this year to try to tackle the difference between debt and GDP, not just the spending itself, but policies to increase GDP. We will have to wait and see if they come to fruition and some of those plans pan out and the debt to GDP ratio can actually decline. And this is your chart, debt to GDP. Debt in green, GDP in blue on the bottom pane, the ratio in red on the top pane. You can see a flatlining over the last 4 or 5 years of debt to GDP after a massive spike due to the CARES Act and other emergency responses during the year 2020. Let's see how the US GDP continues to grow. The pace looks to be somewhere in the 3 to 4%. That would add $1 trillion plus in GDP every single year or on the annual reading. And so how does that 3 to 4% growth compare to the growth in debt? We'll talk about the US Treasury's issuance plans but tax receipts are very, very important here. What is the prospect of the US government getting to keep its tariff revenue that it has collected this year? The Supreme Court looking at that ruling this week. We don't have any official announcement on when that ruling will be written and handed to the public, but we do know that Treasury Secretary Scott Bessent was present in the Supreme Court this week in Washington, heard the arguments on both sides, had very strong opinions on how weak the argument was about trying to strip away these tariffs, or at least take the power away from the president using these emergency economic powers to implement tariffs. The administration's argument is that the United States was and is still in a national emergency due to the threat from China, specifically defense-related items. If the United States government has that argument, the Supreme Court will have to rule against the idea, the concept that the United States is in an emergency. And that's really where I believe the case will be decided. Betting markets have a lower than 50% probability of the tariffs being upheld. What the betting markets are basically saying that the Supreme Court, it believes the Supreme Court will slash down these tariffs as being illegal, or that the administration overstepped. I don't have an explicit prediction. I think that for it to be far below 50% in the betting market is probably discounted too much. So we'll have to wait for the Supreme Court. That will affect this chart itself, debt to GDP, because debt will be driven going forward on the balance of revenue. And so how much revenue can be drawn from tariffs, is yet to be seen. All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio, and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app, and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com. Use code TBL for 10% off. TBL Liquidity, just the raw index here. You can see that it's had quite a move higher this year that has supported the stock market. We saw 13% trailing 12-month returns on the stock market. Bitcoin has also had a good year, but it's definitely struggled of late. So what are some of the influencing factors on this recent struggle? Definitely the dollar putting in a bottom a couple months ago and moving higher. That dollar strength has been the main restrictive condition on Bitcoin. We take TBL liquidity and then we dive into the numbers. We're looking at TBL liquidity's change over 12 months to give us a broad sense of what the liquidity conditions are. But then we take that and we apply a 30-day change to it. And that way we can look, how is liquidity coming in and out of the system? Now on the top pane, the purple bars are these 30-day changes, and the blue line, it's a smoothing mechanism that we have applied to see what is the trend in liquidity, in or out. When that trend crosses above or below zero, we applied buy and sell triggers to it and ran the numbers, and we saw that yes, if you look at Bitcoin and the stock market on this shorter term liquidity cycle, you can outperform the market with buys and sells Basically, what you're doing is you're taking bond volatility, interest rates, the dollar, and letting it tell you how to trade risk markets. Now, you can see our last buy signal was triggered at the end of August, but a very shallow slope on that buy signal. And we actually got a sell signal that was triggered a couple weeks later. And through that sell signal disappearing from our metric, we understood that this smoothing mechanism that we're using, the only way that it can smooth is it does take a look at backwards data and try to adjust for choppy data. And you can see there that looking at the purple bars during October, a couple spikes and a dip down, this is noisy data. And that's why you see on the TBL liquidity indicator, the bottom pane, it's not a very clear cycle up and cycle down. It's kind of flatlining. And therefore, the signal, the buy signal that we have is a weak one. And those that are connected to our research dashboard, all of our TBL pros out there, and you can become one at thebitcoinlayer.com/subscribe. They're getting a buy meter and a sell meter that is either classified as strong or weak depending on the strength of our liquidity index and how it's changing, specifically the strength of the change. Is it strong or not? And this current one really proved to be a weak change in positive liquidity, and therefore has really not impacted the Bitcoin price in a positive way. You could see it turning over and the Bitcoin price really behaving poorly over the last couple weeks. This has caused us to take a closer look at the numbers, what our indicator is producing, and we're raising the signal, trying to give you guys more actionable information to interpret the Bitcoin market. So remember, TBL pros can get all of this information on our dashboard, thebitcoinlayer.com/subscribe. As we were tweaking our TBL liquidity indicator and understanding this smoothing mechanism that we have applied, what we want to do with that TBL liquidity indicator is give you today's impact on the market. What are the main drivers today causing Bitcoin's price to move? And we talk a lot about bond volatility. So yes, the bond volatility metrics are the strongest contributor to TBL liquidity. What we then did is try to reduce the impact of the MOVE index bond volatility and give ourselves a little bit more of a leading indicator. Damien Schott asked a brilliant question this week, which was, hey, when you see tightness in repo markets, is it causing the Bitcoin price to go down today? Or is that tightness in repo markets going to impact liquidity, which impacts credit creation, which in 3 to 6 months will slow down the Bitcoin price? The answer is both. And what we wanted to do is show you what the numbers actually told us. That if bond volatility spikes and the Bitcoin price goes down today, it's easy for us to say, hey, look, A caused B and it happened today. But what about things that happened 3 to 6 months ago? How do we factor in credit creation 3 to 6 months ago and how that impacted the Bitcoin price? Well, our fantastic research team continues their R&D in this part of the TBL liquidity framework. And Agustin Carrasco has made a great discovery for us, taking the MOVE index down as a contributor in this TBL liquidity wave and increasing the importance of banking assets. Because banking assets going up, first of all, banking assets going up doesn't happen on a day-to-day basis. We get weekly or monthly information at best from the commercial banks and the central banks around the world as to how their balance sheets are growing. Now, does that balance sheet growth affect the Bitcoin price on that day or with a 3 to 6 month lag? It's the latter, 3 to 6 month lag. So increase banking assets as a contributor to our TBL liquidity wave. And what we discovered is that The wave leads Bitcoin and stocks by about 6 months. A fascinating discovery, a function of us changing the weights of our index and trying to understand what are the drivers today and what are the drivers for 3 to 6 months from now. Lot of exciting research coming from the Bitcoin Layer research team. Make sure you go to thebitcoinlayer.com/subscribe and become a pro today and start messing around with these charts in our dashboard. What this chart shows us, our wave in dark colors and the Bitcoin price in orange, it shows us that Bitcoin is responding to banking asset shifts 6 months ago. And that in that way, we have to look at what's happening with banking assets to give us a sense of what the Bitcoin price will do going forward. Right now, our wave suggests that Bitcoin is going to have a positive price experience over the coming 6 months. But yes, you can see the dip in liquidity that we had in the second to third quarter of this year has started to impact the Bitcoin price today. So we'll continue to dive into the numbers. We care so much about the numbers, guys, because if the numbers don't confirm, then we're just blowing hot air, and that is not our intent at all. We need to understand what our metrics are telling us. What is the back-tested data telling us? And I promise you that we are spending every day on this to try to bring you the most signal that we can. Moving over to U.S. Treasuries, let's look at 5-year yields. Right now trading right below 3.75%. 5-year yields steady for the last 3 years here in the U.S. We got big news out of the Treasury Department. The Treasury will not be issuing larger auction sizes in the long end of the curve for at least the next 12 months. This is welcome news to 20, 30-year bond investors, as they will not be hit with a ton of new supply to their portion of the curve. That will keep supply low, and whatever existing demand, it'll support prices. We don't expect a dramatic steepening in the yield curve and a run-up of 30-year yields unless there is another big inflation wave, which we don't see on the horizon. We see signs of inflation for sure, but not that 4 or 5%, more like getting back to 3 and above 3%. The big news from the Treasury Department, not just that they won't be issuing long-dated bonds in any increased supply, but also that they don't want to issue too many more bills. This is something we've been talking about, that the Treasury will just issue as many bills as they can. They would actually rather issue some of these 2, 3, 5, and 7-year notes instead of bills to try to limit the amount of bills as a total percentage of marketable debt. The decline in interest rates in the 2 to 5 year portion of the curve definitely responding to Fed cuts. We know 10 and 30-year yields don't respond to Fed cuts, but 2 to 5-year yields do. A decline in these yields throughout the next 12 months will get the Treasury Department in a position where they can increase the size and actually reduce the amount of interest payments going out to current bondholders that purchase treasuries at 4 and 5%. They'll now be purchasing them closer to 3%, and that will help the line item of interest expense for the U.S. government. Looking at 30-year yields, it doesn't have that same rollover that we've had in 5-year yields, a still, gentle increase, steady increase in the trend, but you can see there a flatlining over the last 2 years, not 3, but 2 in the 30-year part of the Treasury curve. This is stability. This is very important. The Treasury market is the number one most important metric for the U.S. government and its stability. If this yield goes up, it's bad news for everybody, actually. It's bad news for borrowers. It's bad news for the government. It's bad for the fiscal health of the United States. It's bad for those that are going to be experiencing the inflation. The yield rises as a result of inflation. It's not the cause of inflation. So if it rises, it's going to be because inflation is getting bad. We need to see this yield continue to remain stable. What's going on in the US labor market? Here we have average hourly earnings, the year over year change, 3.7%, the growth in wages. That is above the current CPI. So from that perspective, this is very good wage growth. We want to see wages outpace inflation. That is a contributor to real wealth for people, for Americans. And so we want to see wages stay at above the CPI level. Even though the US government was shut down and we did not receive non-farm payroll data, we did receive ISM, which is the Institute of Supply Management, one of the longest standing data series that we have in the United States is the ISM manufacturing. First, let's take a look at ISM services printed above 50 at 52.4. There you see on the bottom pane, that's 2.4 points above this midline of 50. So in an expansion, labor did tick up, but still in contraction. So that's where you see job hiring is still in contraction in services. Prices paid quite high at 70. There is definitely some inflationary pressure within the US economy. It's not really showing up in Treasury yields yet, but CPI has ticked up a little bit over the last few months. ISM manufacturing still in contraction, and you see about 3 years of recession in the US manufacturing sector. Employment in the manufacturing sector still in contraction at 46, but on the good side of things, a drop in prices for the manufacturing sector now to 58, and that's a drop that's been in place for the last 3 or 4 months there. We talked about credit card debt at the beginning of the show. Credit card delinquencies for new balance or new delinquencies, a little bit of a spike over the last few months at 8.88%, but a healthy sign in the green and red lines, a decline in delinquencies in the auto and the mortgage sector. So the US economy is in a leveraged position that is not negatively affecting the broad economic growth and consumption. And we can see a rollover in delinquencies in auto and mortgage and take a very good message away from what's going on in the economy. The least credit-worthy borrowers are going to be in that credit card sector, and those new delinquencies are definitely showing a sign of increase, which means some weakness in credit. A repo update for you guys. Repo rates have come back down. They are still slightly above IORB. It means that there is still tightness. There's no doubt about the tightness in the market. It definitely has relieved itself this week as we get past that October 31st settlement and month end, where the spread spiked out massively. You can see on the bottom pane that red spread there spiked to above 30 basis points, but now at just 2 basis points. Tightness, but walk back from the near crisis feeling that the market was giving off last week. I told you guys that I didn't want to call it a crisis because it wasn't one. It was tightness in the market. You can see it coming down. Now we'll watch going into the mid-month settlement, November 15th, when other Treasury securities, and that's actually, I'm looking at the date, the 8th is a Saturday, the 15th will be a Saturday, so that Monday the 17th, Treasury securities will settle on that day. We'll need to watch. There's also Thanksgiving coming up in the United States. There will be thin trading. I'm sure that banks will want to get over the turn starting in early November, meaning how do they get their balance sheet funded to the first week of December? Will that cause another round of tightness in the repo market? I can promise you that this 2 basis point spread of SOFR to IORB will not be the low point for November, meaning that I can basically guarantee you going into November 30th that this rate and spread will tick back up. It's how much will it and what will the Fed do, if anything. There's a chart I want to show you here. Standing repo facility, the usage is gone. We noted the pickup. It was an emergency facility. It's gone now. It means that that extreme tightness at the end of October, it's done. But will you see this number come back up off of zero toward the end of November? Yes, I'm telling you yes. That's because of the tightness in the funding market. The Fed, though, knows all of this. They've been watching it. They announced a slow to QT in April, guys. That's 7 months ago. They slowed QT from 25 billion a month to only 5 billion a month. Now they're going to end it, and they're going to eventually increase the balance sheet. But they have been watching this for a long time. You go back to that SOFR chart, and you can see that at the end of 2024, September and December, there were spikes in the SOFR rate. There was tightness on the calendar turns last year. So they've known this is there for a while. They are trying to get out in front of it. What is the source of the tightness? Well, it's this purple line, 3.16 trillion. This is the quantity of SOFR that's traded every night. This is repo transactions between money market funds and dealers. This is not the Fed trading with the market. This is the market trading with the market. And the 3.1 trillion means every night 3.1 trillion of Treasury mortgage collateral. I have a chart here in a second to show you the breakdown. There is a ton of collateral that needs to be funded every night. That is the driver of the tightness in repo markets. Now, if that number, 3.1 trillion, needs to be funded every night, reserves need to be able to fund some of that market. And right now, reserves at 2.8 trillion and in decline, partly due to the buildup of TGA. When the shutdown ends and the government is able to spend money again, the reserve balance will go back up. Is that enough to calm repo markets? Probably in the short term, but how much and for how long? Probably not for that long. On the government shutdown, what is going on in the Senate? The Democrats cannot find a few votes to get the vote above 60 and pass any continuing resolution, any spending bills. There seems to be complete chaos in the Senate, and it's causing chaos from the executive branch, trying to boost the idea that the filibuster needs to end, something that absolutely helps to preserve separation of powers and avoid one party from getting too much power. So thanks for sticking with us for a big global macro update, markets update, Bitcoin, Fed, the US economy, lots more. I'm Nick Bhatia for the Bitcoin Layer. Make sure to go to thebitcoinlayer.com/subscribe. Become a TBL Pro today. We'll catch you guys next time.